It should have been a banner day for the Bank of Canada. Their sixth consecutive interest rate cut, bringing rates down to 3%, and inflation's been below 2% for months. But it's the threat of tariffs that continues to loom over the Canadian economy.
This could be very disruptive to the Canadian economy and is clouding the economic outlook.
And that might even be an understatement. If Donald Trump follows through on his 25% tariffs, the bank estimates Canada will head into a recession and inflation will likely jump back up, regardless of the response from the Canadian government. Over 2025 and 2026, there'd be a between 2 and 3% decline in GDP, while inflation could go up more than 2%, undoing much of the work the bank has done over the past 2 years.
A long-lasting and broad-based trade conflict would badly hurt economic activity in Canada. At the same time, the higher cost of imported goods will put direct upward pressure on inflation.
Look a bit deeper, and this scenario is even more bleak. Exporters would see a significant decline in business, leading to layoffs. Oil prices would likely drop, a key part of the Canadian economy. And the Canadian dollar would continue to fall below 70 cents. And if tariffs stayed in place for the long term, the Canadian economy would have permanent scarring, but there isn't much the bank could do.
Monetary policy cannot offset this. What we can do is help the economy adjust.
Even without tariffs, the bank cut their GDP growth for 2025 by 0.3%, sent down by estimates of negative population growth, and reduced business investment from the threat of tariffs. The Bank of Canada has also ended their quantitative tightening program, a signal they believe their fight against inflation has come to an end, but it could have to quickly restart if tariffs come into place. Mackenzie Gray, Global News, Ottawa.